So our first choice was buying a call option. It's where we look for an expiration date about 26 days out. So I want you to imagine that you found yourself a really great stock and you're bullish on this stock. So you give yourself two choices. Am I going to buy call options or am I going to sell a put spread? Now, both of these have their pros and they have their cons, so it can be pretty tough to decide. But does one of these trades have an advantage over the other? Well, we're going to have a quick rundown of each of these. And that way you can make a more informed decision about which one to use. And make sure you hit subscribe and that little notification bell. It really helps us out putting out these videos for you. So what does that mean, buying a call option? Now, we've covered these in videos all across our YouTube channel here. A call option is a bullish options contract that gives you the right, but not the obligation, to buy 100 shares of an underlying security like a stock at a certain price, and that price is called the strike price, within a certain amount of time. And these contracts end, and that end date is called the expiration date. It is a purely directional play. Okay, we need that stock to go up, and we need that stock to go up quickly. If things are going well, you can profit quickly. The profit potential is high. It's an aggressive trade because the moment that you put that trade on time decay, it's called theta in the Greeks, it's not in your favor. If volatility dries up, time decay ticks away, you may end up holding a worthless contract. It's high risk, it's high reward, and it's an excellent trade if you are an aggressive trader. Selling put spreads a little bit different. It involves purchasing one put option while selling another one with a higher strike price. So the idea behind the put spread is you want to limit your downside risk while still allowing for profits if that underlying security falls in value. But it has to stay above the strike price that we sold. It's a conservative trade. It's got limited upside potential, but it allows you to profit 5 different ways. Put spreads are also cheaper to put on. And yeah, they have a lower risk, a lower reward profile. But if that stock goes up, down, or sideways, time decay ticks away, lower volatility, you can profit from all of that. Now, this is a past trade, and it is an excellent example of deciding which one to use. And this is Dollar Tree. And we saw an oversold stock, and it was starting to bounce to the upside. So we're slightly bullish on this trade, given the overall market condition, which wasn't great. And our time horizon was a little over 3 weeks. So our first choice was buying a call option. It's where we look for an expiration date about 26 days out. So we decided maybe we'll buy the April 70 call strikes for $9 or better. And on the Friday, they were trading at $8.80. That's the premium, and you also have to multiply that by 100. The profit loss breakdown, we would target a 100% return. We would risk 50% of what we paid. So we would have paid $880 and we would have risked $440. But we also would need that stock to rally above $78 in order to find break even. That's just the strike price plus the premium that we paid for it. Our other choice, selling a put spread using the same expiration date, 26 days out. So we want to sell the April monthly 70-65 put spread for $1.50 or higher. This means we would sell the 70 puts and we would buy the 65 puts at the same time for $1.50 or higher. So at the close on the Friday, this spread was trading for $2.22. So if we got filled at this price, the maximum profit you can make on that trade is $222. Your risk, slightly worse than 1-to-1. It was $278. The break-even price is $67.78, which is the 70 strike minus the premium collected of $2.22. So yes, we give up that home run potential, but it's a decent trade-off for a cheaper trade, and we have multiple ways to profit. And we would not hold this to expiration. That's not how we do it. We would close this spread when we could buy it back and keep between 50 to 75% of what we collected to open the trade. Well, here's the stock chart of Dollar Tree from that period. So after the trade was put on, time decay, boom, starts working against you. Price retraced to $70. So that put spread, as long as the stock stayed above our break-even price, we're fine in holding it. We're going to make money. So in the end, if you exercised your call option and you bought the stock at your strike price of $70, which you could do, and then you sold it at expiration, the shares, you'd have made money. Fact is, most people do not ever exercise their contracts. They just simply sell to close their trade. So those that sold a put spread, they would have benefited from the time decay, the sideways range, the move up in price. Now, this trade could close for the maximum profit again, but as I mentioned, we prefer to keep 50 to 75% of the premium that we got. So as you can see, just looking at this chart, the put spread was cheaper to put on. There is less risk involved, which is what you want as a trader. So which one would have been better? Well, the answer depends on you. So for a lot of people, that immediate decline in price would have been painful to sit through if you're holding a long call. The sideways range, it was in the money, but that also could have challenged a trader who was expecting a large move up in price, which is what you want when you're holding a call option. If you're holding a put spread, well, it was a relaxed trade because you knew you were making money. When it went down, when it went sideways, that rise up in price didn't matter to you. So what do we like at NetPicks? Well, Mike, he's our resident options instructor. He generally prefers put spreads. Put spreads are going to limit your downside risk. It's defined. It allows for profits, even if that underlying security falls in value, and as long as that stock price stays above the strike that you sold. They're cheaper to put on, and yeah, they do have a lower risk and a lower reward profile than buying a call option. Lower risk, that's important. You can profit from a put spread if it goes up, down, sideways, time decay, lower volatility, all 5. And you can close them when you buy back the spread and keep between 50 to 75% of what you collected to open the trade. Now, let's be honest, you do not need to have tens of thousands of dollars to start trading. You just don't. People think you do. We have a free guide. It's one-day options trading strategy. You can make money whether the stock market goes up, down, even sideways, like we just talked about here. You can grab it. It's called the 8 Minutes Options Cookbook. You can download it. It's totally free. Appreciate you watching this video. Make sure you hit like, subscribe to our channel. It'd be really awesome if you did that. Any questions or comments, pop them below. We'll catch you in the next video.